Happy Wednesday, Bearded Tog, folks. This is an episode that you are going to need your notebook for. So if you're driving, I apologize. If you're running, I also apologize. Get out your notebook, go sit on a bench somewhere, or go get coffee as a personal expense, unless it's with another business owner. This episode is one of those things that in business, I feel like every small business should have. This is the episode, ironically, unlike the inspirational ones that we've had on before, this is the one you should share with every business owner you know, just so they can, I live by this motto, check yourself before you wreck yourself. This is the episode. So we're talking to Amy Northard, who's a CPA for creatives. She's absolutely incredible. She's super sweet. And the idea is that we're walking through different misconceptions, different things when running a business that business owners run into, new business owners, profit, loss, sole proprietorship, LLC, S-Corp. How do we retire? What do we do about receipts? What do we do about sales tax? All of those things. Do kids count as tax exemptions? What should we do? We walk through a portion of all of that. And I would love if you took some time and listened to this. And then afterwards, let us know how you're doing. Check your business. If you remember, it's your first time doing profit and loss statements, let me know in the show notes and shoot me an email, thebeardedtog@gmail.com. But seriously, this episode is going to be a packed one for you. So without any further ado, here's Amy. Amy, how's it going?
Great. Thanks for having me.
Awesome. So I want to know about you because everybody in our field talks about, having a CPA or taxes, and there's just so many questions and everything like that. And you are you're the coolest accountant slash CPA I've ever seen in my life. Your branding is up there with any small business and modern small business. So but something I read in your Instagram bio is about you are the mother to the world's cutest tax exemption. And so we'll get into why it's called this, but tell me a little bit more about that whole process, and then you can give some background if it makes sense if you want.
Yeah, so world's cutest tax exemption, that would be my 9-month-old son who stays home with me and my husband. My husband watches him while I do all my business stuff, and then I'm able to take breaks and see him at lunchtime and at nighttime. But he has definitely pushed me to make some changes in my business, which I'm sure we'll talk about. But yeah, he's a lot of fun.
That is awesome. Just for some background, tell everybody kind of where are you from? Where are you based out of?
Yeah, I'm based out of Indianapolis, and thanks to good old internet, I'm able to work with people all over the U.S. So I think a lot of people assume I'm only working with people in Indiana, but I have clients all over different fields of business, mostly creative industry, and they're just a lot of fun to follow and interact with.
I love that. Have you ever watched Parks and Rec?
Oh, yeah. Yep.
Okay. I'm anybody from Indiana, and I'm a Patriots fan, so I would never reference a Manning brother.
Right.
So you might as well do that. That's hilarious. I love that. Have you always been, what's your title? Because I feel like people say accountant versus CPA. Are those things the same? Help us out for creatives who don't really know that field.
Yeah, I use them interchangeably. So kind of my tagline is accountant for creatives. And I have my CPA license. Once I got that, I kind of had a quarter life crisis, if you will, and decided I did not want to work in a traditional CPA firm for the rest of my life. So that's kind of how it kind of pushed me to start my own business, because I wasn't finding anything that I really enjoyed. And I've always just loved the creative world. I don't necessarily specialize in any one thing creatively myself, but being able to play with Instagram and hire a photographer and do a calculator photo shoot and style that stuff is so fun that you don't get to do in a normal accounting business.
I love that. Well, in theory, they should have a marketing department, but most of them probably don't. They're just hey, were very needed. Okay, that's awesome. Were you did you start your own business like right out of school or after you got your CPA license, or did you work for a firm at all or anything?
I interned at a firm while I was in college, and then after I finished college up, I started working full time at that same firm, and worked there for a couple years while I got my CPA license, and then that was kind of the point where I was like, okay, I worked my butt off for this, but I don't enjoy it. So what am I going to do that still retains that CPA license, and my dad won't kill me if I like completely switch what I'm doing? So this just ended up being the perfect combination of still using my skills as a CPA, but enjoying what I'm doing every day.
I love that. That's awesome. It seems like from your website and Instagram and just, I kind of wanted to find a CPA or accountant that was like fun and, you know, had a personality to have on rather than, no offense to my accountant, but they're not as fun as you. And, you know, they're just not relatable. And I feel like people, when they approach anything with money or taxes or the government, these things, it's very intimidating because, you know, most people they specialize in this thing that's not related to those. And so having somebody who's background and is expertise, and then they're also very friendly and personable, like that's the perfect match for your field.
Yeah, I feel like there's so much judgment out there, or perceived judgment. Like, oh, if I tell them that I haven't been paying taxes all year, they're gonna, you know, reprimand me or something. And I think that kind of stems from like using your parents' accountants that have just kind of been passed down to you, and they might be a little bit more old school. And I tell people I work with all the time, whatever you are worried about, I've seen 10 times worse. So don't feel bad about it at all. And, you know, we just make a plan to, if they need, correct whatever's been going on and get them moving forward, because they don't want to have to focus on the tax side of their business. They want to focus on creating beautiful images if they're a photographer and that sort of thing.
Right. Totally. It's, you know, the reason somebody outsources is so they can focus on the main thing, hopefully, or have more free time. And so, yeah, there's something special. I know when I hired my accountant, it was like the fact that they took care of bookkeeping was so refreshing. And, you know, they just, at least for us, our workflow is they email me once a month and they're like, hey, Adam, here are some things we didn't have categories for. Can you tell us a little bit about them? And so I just kind of like fill them in. It's usually like a handful of transactions. It's not many. And then after that, they send me like my quarterly, or they send me my monthly, you know, profit and loss statement. And it's just like almost on autopilot, if you will.
Yeah, that's the same way we work with our clients too. And it's so nice because you don't have to take the time to figure out like, why did all these transactions get double imported, or why is my bank balance not matching what's actually in my bank? So, you know, having that, having like a monthly retainer for a bookkeeper is so nice because, like you said, like it's kind of automatic, and there's going to be questions they have every month. But, you know, once those get done, then you get to see how much money you made and use that information strategically rather than using your time to focus on the details of it.
Right, exactly. It's like you don't have to dive into the weeds for those particular things. That makes sense. So what does a normal day look like for you? You know, you don't have to say like how many clients you have, but are you, you know, mostly hanging out in like QuickBooks or some kind of software like that? And then, you know, are you always acquiring new clients? Like what's your week to week look like?
Yeah, so I kind of have like two typical days, one during tax season and one outside of tax season. So during tax season, I'm pretty much at my desk, you know, 12 to 15 hours a day, usually 6 to 7 days a week. Hopefully with the hiring of a new full-time employee, which I'm really excited about, that will be a lot more normal. Like there won't be as many 7-day-a-week work days. But during that time, it's just cranking out tax returns because we've got quite a few, like literally I'm doing over 400 tax returns within like a 3-month time period. So,
whoa.
So yeah, we're
That's
cranking
crazy.
through that stuff. And then after tax season, it's definitely way more relaxed.
That is crazy. 400 tax returns.
Yeah, and it's so weird because I hear like, I'm in those Facebook groups with other accountants and we're trying to help each other out, and I hear the numbers from other accountants, and everyone's business is different, but it seems like a lot, but when you're in it, it doesn't seem that bad. But yeah, we definitely get through those, and having this other accountant now, we'll have 2 sets of CPA eyes on each return, and then we'll probably end up hiring a person to do the data entry and preparation. So that's going to make it probably life-changing.
That's so cool. That's awesome that you've been, able to expand. I think that's really exciting, and that's really fun. How long have you been full-time?
I've been full-time with my business about 4 years.
Okay.
The business is about 6 years old. And so now my husband's been full-time with me for almost 2 years now. And then, so now we'll have our 3rd full-time person in it.
I love it. That's awesome. That's like, you've got a little empire going. That's what I always tell companies when they have like 4 or 5 people and they're growing. That's awesome.
Yeah. So outside of tax season, the schedule is definitely way more relaxed. Like this morning, me and my husband and my son just watched the news, had breakfast, got started around 9:30, and typically during the summer, I'm doing new client calls or consulting calls with my current clients, and that's the majority of like my Tuesday, Wednesday, Thursday schedule. And then the rest of the week is just getting extended returns done and anything else that might come up. Like we also do bookkeeping here, so reviewing bookkeeping and all that fun stuff.
I love it. That's awesome. So give me some terminology and kind of like demystify a few things for us. So things like the tax return, your quarterlies, expenses, and write-offs, like help define those things for people who maybe don't know what those are, or maybe they've only heard from another creative. Like help set the standard for what those things mean.
So a tax return is, you're probably used to, if you haven't filed taxes for your business yet, you're probably used to at least filing taxes for your W-2 if you work for a job. So you're reporting your income, and then hopefully you'll get a refund back. But as you get into replacing a lot of that W-2 income with self-employment income, you're not having taxes taken out of your paycheck when you receive money from clients and customers. So that's where quarterly taxes come into play. And those are going to be where you're just essentially sending a chunk of money into the IRS and your state. You're not actually filing any information when you think about quarterly taxes. You're literally sending in, however much, maybe $200, maybe $2,000 each quarter, and telling the IRS that you want it to be applied to your year-end tax balance. And then if you send in too much, you'll get a refund. If you don't send in enough, then you'll still owe money at tax time. So that's the deal with quarterly taxes. I hear a lot of confusion with quarterly taxes also when people think about sales tax, because some states have sales taxes that are filed on a quarterly basis. So typically, when you hear quarterly taxes, it's talking about the first thing I talked about, where you're sending in income taxes and just sending in a deposit. But it's a good thing to clarify if you're ever talking with another small business owner, like in a Facebook group or anything like that. Clarify what they're talking about, because they sometimes are referring to sales tax too.
Interesting. Okay, so to kind of translate, if you will, like, small businesses, if we make a profit, we're taxed on that profit by the government, both state and federal. And then from there, they're going to take a portion. And if that portion, like our employer on our W-2, they would take it out for us. And so we have to take it out ourselves. or a lot for that amount. And then the government's going to get what it's supposed to be owed. And ideally, when people say quarterly, we're kind of paying in advance, like you said, so that we, in theory, either don't owe or if we meet it, hopefully, if your projections are right. And then if you owe more, then usually that means you made more or made more profit, like generally. That was like the biggest thing for me was like for the longest time when I first started, I didn't pay quarterlies just because I would rather just save up until the end of the year. But your first few years, you can do that. But after a while now, like I could never do that. Like it's good to pay quarterlies.
Oh yeah. I feel like it's a huge game changer, stress wise as well, just because, it's a little less painful to have to write $4,000, $5,000 checks to the IRS versus one $20,000 check to the IRS. It still sucks no matter how you think about it, but I feel like it's a little less painful. And if you have that money out of your hands, you can't spend it during the year. So like if something comes up and you need the money, you have already given the IRS the part that they're going to take no matter what eventually. So then you'll figure out how to get your hands on the rest of the money, whether it's doing a flash sale or something to generate funds. I just think that out of sight, out of mind is best with money for your quarterly taxes.
Right. That makes sense. Now, walk me through like what is one of the most annoying or silly problems you see like creatives have, whether you're bringing on a new client or something you read in a Facebook group and you just go like, come on guys, that is not true, or like, come on, like this could be better, or this should be common knowledge. Like what's the one thing that you see super often that people should change or people should know?
Oh, that's a tough one. So the big thing I see in Facebook groups that kind of annoys me is if people ask questions about sales tax and other people chime in with what their state does, but they think of it as like a nationwide rule. So this person is getting false information about what they should charge sales tax on or what they shouldn't. And in those cases, don't crowdsource tax information. It's good. You could crowdsource who to go to for tax information, but don't crowdsource that stuff because it's so state specific and even job type specific. Like in some states, certain sales tax rules apply to photographers, and a similar situation might not apply to, a videographer in comparison. So don't crowdsource tax information.
That is funny. That's pretty. What is, so like I grew up in a state, I grew up in Delaware where as a consumer, we had no quote unquote sales tax. As a business though, like those businesses still get taxed for sales, or is that something that they just don't have to deal with?
So if the state doesn't have sales tax, then they don't have to deal with it, which is really nice. But usually the state will get tax in some form. So they're making up for that in some form, whether they have a high income tax rate or they have high property tax rates. So they're not just giving that source of income up, millions and billions of dollars. They're getting it somewhere else too.
Right, exactly. Through like land or property okay. Yeah, that makes sense. So what's the best bet for somebody who's even in that zone? Like who should they talk to? Obviously we would say their accountant or like their CPA, but like for a photographer, because that's most people who listen to this, like I've always heard for sales tax things about the cost of goods sold, or like if you don't sell digital products or you sell physical products, there's some differences. Like what is something that you've seen, or maybe, you can even use Indiana as an example, even though it might not apply to our state.
Yeah. So with sales tax in your state, some states like California has this great PDF that you can Google, like basically just Google California sales tax, and it should come up as one of the top hits. But they have a whole PDF on how to implement their sales tax rules into the photography business. I think off the top of my head, Texas might have one too. So if you are, just starting your business, even if you've gotten into your several years into your business and you just haven't taken the time to look into the sales tax rules for your state, take some time to just check into it, because it's one of those things that it sucks if the state comes to you and wants to audit your sales tax, and it's just a pain. So if you can know and have the confidence you're doing it correctly, then it's just one less thing to have to worry about. And so if you're in a state where they don't have one of these nice little neat guides about how to apply the sales tax rules to your business, a couple things. Yeah, you'll want to work with a CPA. Ideally, they're local for sales tax type issues, but I help people all over with sales tax, interpreting that stuff and how it applies to their business. So you can work with someone virtually as long as you let them know, this is a state issue, and ask if they can help with it. And then if you don't have a CPA, ask around for your friends to see who they're using, who they recommend and really enjoy working with, and then reach out to that person and see if they could chat with you a little bit about the topic.
Totally. Now, when it comes to things like federal versus state taxes, are those essentially, I don't want to say the same, but like obviously both sections of our governments want to get paid. But like, I would say like for tax write-offs, those are only for federal, or do those get written off for both? Like, how does that work?
Oh, good question. So the way it works for most states, and some states like California are a little bit of an exception, but generally how it works is you report all of your income and your expenses for a sole proprietorship or a single member LLC on a form called a Schedule C with your personal tax return. So then that profit from your business gets added to any other income or personal deductions that you might have. So if you work a day job, your photography profit will be added to that. If you have student loan interest, that will be subtracted, and that essentially gives you your taxable income, taxable earned income. So that number essentially flows through to your state return, and then it gets taxed there. So you're not having to report all of that business detail on the federal return and then on the state return. They're just using that bottom line number from the federal return to calculate your state tax. Oh. And like I said, a lot of the states operate that way. Some are a little different, but that's generally the rule of thumb with how the different states work. Sure.
Now, what would be a state that does things differently? Do they usually make it harder for business owners, or do they make it easier or harder for you guys and easier for business owners?
I think California is probably a good example. So if you are an LLC in California, you will have to file like your annual report, but you also have a separate LLC return that you file. So you would file your regular federal personal return. You would file your personal state return and pay state tax on your business income. But then there's an additional LLC form that gets filed, and you pay your LLC tax there. So there's an $800 minimum LLC fee that California charges. And that essentially just gets assessed with that extra form. But that's just one of the examples off the top of my head that's a little bit different.
Dang. So just to the business owner ears, that just sounds like more taxes owed initially, in theory, right?
Mm-hmm. Yeah. California is the most expensive state to have an LLC in. Even if you made $0, you would still owe that $800 every year, which stinks. And even if you were to create your LLC in Indiana and then move to California and operate your business there, you still have to register as a foreign LLC and pay them their $800. So they'll get it any way they can.
That is crazy, but I guess it makes sense.
Yeah.
They're going to make it happen one way or the other. That is incredible. That's awesome. So give us, we kind of joked about it at the beginning, like why, I feel like people know this, but as somebody who doesn't have children yet, why is a child a quote unquote called a tax exemption, or why is that the joke, or even a house? Like when people buy a house, like as a business owner, how can those things affect our taxes?
The joke has been like kids are an exemption or a write-off. And previously, before 2018, before all the tax law changes, you used to get about $4,000 per person in your family as an exemption. So every kid that you had would reduce your taxable income by about $4,000, which is awesome. That equates to about $1,000 less tax that you would have to pay. So that's kind of where that came from. With the tax law changes, though, actually, they've kind of changed things around. They increased the child tax credit that they're giving out per kid. So you still get a benefit. But they got away with that like $4,000 exemption. And without getting into too many of the like nitty-gritty details of it, they raised the standard deduction, so they just about doubled it, but then they got rid of this exemption. So your standard deduction will not increase the more kids you have, but that child tax credit could potentially give you some more money back. Same thing with the house. The house would usually give you enough deductions on your personal return to start itemizing deductions. So what that means is you get a standard deduction, but if all of your itemized deductions are greater than your standard deduction, you get to go that route. And mortgage interest, real estate taxes, those are going to be things that happen when you buy a home. Those typically will be greater than the standard deduction prior to 2018. Now, if you are single, the standard deduction is $12,000 and the married standard deduction is $24,000. So the chances of your mortgage interest, if you're married, exceeding $24,000, unless you like to donate a lot of money to charities, is going to be really low.
That is so crazy. So sorry to kind of like beat a dead horse, but even just walk us through like the standard deduction. Does that just mean like that's the standard amount that the government wants from people in a certain tax bracket?
So the standard deduction, like let's say you made $10,000 and the standard deduction for an individual is $12,000. Since you didn't make above that standard deduction, you don't need to file taxes for the year. But let's say you made $100,000 and the standard deduction for an individual is $12,000. So that is just going to reduce your taxable income. So instead of being taxed on $100,000, you're going to be taxed on $88,000. And that's the standard deduction. So if you add up all of your itemized deductions, so that's things like the mortgage interest, the real estate tax, charitable donations, either through cash or non-cash, and those sorts of things, and those are greater than the standard deduction, you get to use that higher number instead of the standard number.
Right. Okay. That makes more sense, because I was just more curious of like, this term standard deduction. Where does that come from? Does that come from the state or federal? And they're like, this is how much we're going to give you off your taxes. Like what is the standard deduction? Like not number wise, but what is that for?
I don't know the background of it. I think it's mainly used kind of as a threshold. So if you don't make a whole lot of money, you don't need to have the additional expense of having to file taxes, and go through the process. So if your income is less than the standard deduction, then you don't need to file. And states have a standard deduction as well. So if you look on your state return, there should be a standard deduction in there too. And I think it's the same concept. If you didn't make over this amount in our state, then you don't need to file a state return here.
So does that mean, and I love just kind of like picking your brain on this, and I know other people listening are probably going to ask this. like, if somebody makes $13,000 though, you're not saying that they're going to have to give away 12,000.
Right. Yeah. You're not giving away anything. You keep it all. It's just if you made 13,000, then you would subtract 12,000 from that number and then only have to pay income tax on 1,000.
Okay. So that deduction. Now, is that deduction different for different people? Different? Is that like what the tax bracket means? Like how is that number determined?
So with 2018 and beyond, the number is going to be 12,000 if you are not married and you're single, and it is 24,000 if you are filing joint return. That's as simple as it gets. And states have a similar process for that, so states are going to have a married or per person deduction on their return too.
Awesome. Very cool. This is so much fun, and I'm sure it's not fun for many people. They're like, what is happening? This is so nerdy, but it's good stuff to know, and it's good to like at least have a grip on as a small business. It's, you don't want to be surprised. That's the main thing. And I feel like having an accountant will help you not be surprised. So here's another good thing that I feel like people talk about. And this whole episode has just been kind of like picking your brain. But I feel like I asked a lot of people for questions just to see what were people struggling with. What's the pulse of people if they had full access to your brain, like what would they ask you? And I was like, okay, we'll try and gather this up. So another thing that we always hear, and I've experienced this too as kind of a larger, my business has been growing. We've been full-time for 3 years. We, like I said, I had to start paying quarterly taxes, which is like a good and a bad thing. It represents growth. It just is painful. That's all. Like when my wife and I, 3 months before we got married, I told her what I owed in taxes, and she was like, what? Like, that's my salary. And I was like, yeah. And then I started paying quarterlies, and I still owe that much, but, or not now, but like I still pay that much, but it's split up amongst four quarters. Anyway, but you see a lot of businesses at like the end of the calendar year, buying gear, buying equipment, buying things to try and like offset their write-offs and stuff like that. Walk me through, one, what they think they're doing, and then two, is that like a good practice, or why are they doing that?
Yeah. So what they think they're doing is reducing their taxable income, which is happening. So let's say you had $100,000 in sales, and then your expenses up until December 25th totaled $10,000. Maybe you're a very lean person. So you have got $90,000 of taxable income that the IRS is going to tax you on once you file your return. I think in the mindset of a lot of business owners, they want to spend it all up so that they don't have to pay that money to the IRS, and they get to keep all the stuff that they're spending money on. So I have a friend who goes crazy on lenses and props for her newborn photography business, and she's really bad about that, spending up all of her profits so that she doesn't pay any tax. And I remind her, what's the point of working as hard as you do all year long to make a profit of, $100 or even negative dollars? What did you contribute to your family for spending all that time? So I think the mindset needs to be flipped, and we need to think about where can we be stashing the money legally to hold on to the most we can. So if you do need a new lens, and the choice is between buying it now or buying it next year, go ahead and buy it now if you need to reduce your taxable income. But if you don't have anything you need to buy, think about putting money into a retirement account. That will reduce your taxable income in most cases, dollar for dollar as well. So if you have that $90,000 in profit and you stash away 25% of that, then you're only going to be taxed on the remaining dollars left. It's not technically a business deduction, but the way it works with your personal taxes is that it reduces that taxable income number. So looking into like a SEP IRA is a really good option, or if you don't have any employees, a solo 401k. Those are both two really great options, fairly low cost, and the SEP is super easy to set up even after the tax year is over.
Right. We're kind of jumping the gun. We'll get to retirement and plans for that. Yeah, the equipment thing, I think too, is, again, we're just going to use easy numbers, kind of like you said. Like if somebody makes, let's say, gross revenue is $110,000, they had $10,000 in expenses, so their profit was $100,000, which is very lean. I want to meet this person and have them run my business, or maybe it would not be that fun. And because they're eating ramen every day, and that's not my vibe. But like, they think at the end of the year, oh, I want to take that $100,000 number down. And you said that if they buy something, it does take the number down. But something I learned the hard way was like, so let's say they have $100,000 in profit, and that's what they're going to be taxed on. And then let's say they go buy a $5,000 computer. They think that they're only going to be taxed now at $95,000. But there's this other thing that, and you know a lot more than I do, like called depreciation. And so is that one of the reasons that you would kind of advise like not to do that? Let's just pretend that they have full retirement, like, is that still a wise thing for them to do? Or can you kind of talk about that?
Yeah. So depreciation, for anybody that is not familiar with it, is essentially the concept of buying a piece of equipment for your business that's more expensive. So think anything $2,500 or higher, you would want to depreciate. And traditionally, you would expense a chunk of the cost over the lifetime of the asset. So the IRS gives you, they tell you what the lifetime is going to be. So let's say you buy that computer for $5,000. The life is 5 years. You can take a deduction of $1,000 for the next 5 years. There is another option called Section 179 deduction or depreciation. And all you need to know about that is you get to expense the entire cost of that really expensive asset in the year that you purchase it, but you don't get to have benefit from that going forward. So you would deduct all $5,000 of that computer this year instead of just deducting $1,000 of it for the next 5 years. Depending on how much profit you have that you're wanting to reduce and maybe what tax bracket you're in. If you're teetering on the next tax bracket, then it might be good to use that full benefit in the current year. But if my business is just ramping up, my tax bracket's going to be way higher in 3 or 4 years, it might be better to spread that expense out. So that's kind of the thinking behind depreciation and whether or not to deduct it all in 1 year or spread it out.
Right. That makes so much more sense. So is that that one section, the exception to depreciation that you mentioned, is that kind of personal preference? Is that something somebody could tell their accountant, like, hey, I bought 2 computers and a lens this year. I would like the full deduction this year? Or is there like an IRS max that they can use? Or is there a loophole that they shouldn't be trying to get to?
The max is fairly high, so it's like north of $100,000. I don't know off the top of my head, but you can. And so typically, what I do is I will look and see like what is best for my client right now. If they're just getting started, then maybe it's better and they already have a loss, maybe then. Adding to that loss this year isn't really going to help them out. So maybe we'll spread it out over the 5 years. If you for sure want to have that deduction all happen in the current year, just let your accountant know. They'll know what you're talking about. You don't have to remember that section number. Just say, can we expense this all this year? And some states will have maximums that are way lower than that $100,000 limit. But on a federal level, you should be fine deducting whatever you've bought during the year.
Right. That makes perfect sense. And I think it's too for people curious, like a camera is something that in theory, the IRS has its own idea of like how long it's going to last, but nonetheless, we assume that a photographer is going to keep a camera longer than 1 year, and that's why that number's that way. And like my computer, I expect them to last a certain way. And now your company, I always joke about this because I'm a freelancer, but I've always wanted to have like a company technology policy and be like, we replace our computers every 3 years, no matter what. But I'm the only person in the company, so it's whatever. But like, so obviously we're not going to get that same depreciation if we do it that way. But it's like, when people are trying to think of things that qualify for that, it's usually things you're going to have longer than a year, and like you said, you said about $2,500. Like, if you have a lens, it's like $2,000. You could still ask your accountant about it. It's not going to hurt.
Yeah, you can still depreciate things less than that $2,500 mark. But I've had clients send me their list of assets, and it was like a $10 light they bought on Amazon. And their thinking was, okay, it's not expensive, but I'm going to use this longer than a year. So I'm going to list it as an asset, because that year long mark was the only thing they knew to benchmark what is an asset versus what isn't. And the IRS threshold even used to be lower. So it used to be only $500. So anything $500 or above would need to be depreciated. Anything below that could be expensed. And so they've made it even easier for us as business owners. If it's under $2,500, expense it like a regular business expense. Make like a small equipment expense category in your bookkeeping and expense it right through there very easily.
I love that. That's awesome. Something we kind of even touched on, just joking about it, and I'm trying to like recall the vibe that we were talking about, but just write-offs in general, like what is a business expense and what is not. I feel like the most common one that people start out with when they're starting a business is like their cell phone, right? So walk me through that. I know the answer, but I'd rather hear it from you. And it's a common thing that people struggle with. They're like, what do I write off? And it's so easy now to be like, is it used for personal or is it used for business? But I think when things, especially photographers, when it starts out as a personal passion, walk me through that a little bit.
So the big thing to think about with business versus personal is it providing a benefit to your business so that you can continue to grow the business? And I would say that includes a MailChimp subscription. You need that to grow the business and reach out to your client base. That's as little as, buying your very first camera. I think the key is from the very beginning, if you can, start out by having a separate bank account, and anything you think might be a business expense, run through there. And then check with your accountant if you have questions. But by putting all of those expenses into one area, you're not having to sift through all of your personal expenses and think back, oh, was this trip to Target for business supplies or personal? And there's things like clothing that I think is really common with photographers, especially event-based photographers. You might buy special shoes or a special outfit to wear only to shoot a wedding. And the clothing is, you would think, it seems common sense. Like if I'm only buying these special, really comfy black shoes to shoot at a wedding, it should be deductible because I got them for business purposes. But the IRS says that if you can wear these clothing items outside of your job, then it can't be deducted unless it's a uniform. So a uniform would be like something with your logo on it, or a broader example would be like a mailman's uniform or scrubs for a doctor. Those are the types of things that could be deducted, but everything else, even if it's specially only worn for business purposes, should be considered personal. And then another common one that kind of seems like common sense that it would be a business expense but isn't, is like, let's say you go to Starbucks just to get out of your home and get some editing done. But you're not meeting a client, you're just going there to get some work done. And in that case, it feels like buying a drink to use their internet would be a business expense. But that one is just more of a personal expense. Unless you're meeting with a client or another business owner for business purposes, you should not deduct that type of stuff through your business.
Right. You reminded me of a funny story when I had to ask my accountant about the clothing thing, because it's like, hey, and you mentioned this, I have these really nice black shoes that I only wear for weddings. And, hey, can I write them off? And he kind of told me, he's like, hey, it has to be a uniform. So usually if it's branded and kind of is like, can be easily told that it's yours, that it's for the brand. And so the shoes are harder to do, but all of the shirts that I wear on wedding day have my logo on them now, like they're custom stitched.
Oh, that's awesome.
Yeah. And I'm like, no, this is a Mason Photography shirt and I only wear this for business. And because I think that too, the big thing with all of this entire episode, and this is hard because like you're the friendliest, nicest, best version of this, but like your accountant's job is essentially to help protect businesses from the results of a bad audit. Essentially, it's not even that an audit would be bad, because if you're doing everything right, then an audit should be it'll be sad, but it should be fine. And that's the idea. Is like all of this is to be able to prove in a very honest and the best way that something was for business. And so, if something I ran into is I was going to Iceland for a shoot for a car company, and I needed to buy a winter jacket because I'm going to Iceland. But that jacket, even though I bought it specifically for that gig, like you said, clothing's not going to qualify. And so if I put that on there on my business bank account, then it'd be really hard for me to prove. And I could say that to the IRS, but then I'd also have to prove that I never wore that personally. And you get into this deep rabbit hole of having to ideally like defend yourself. And as a business, like it's good to choose the easy, honest, but also kind of hard road. That's the better one for us. And so if it's between personal or business, Starbucks, like, hey, if you're going by yourself, then you just make it personal. It's fine.
Yeah, exactly. And along those lines of proving things, I think it's really good if you are out with a client on your receipt, just as something easy for you to do, turn it over either when you get home or when you get back to your office, write who you were meeting with on the back of the receipt. And that way, if the IRS ever needs that information, you're not having to sit at your computer and open up your calendar and try to match up receipt dates with your calendar dates and that sort of thing. And similar concept with your mileage too, especially with photographers driving back and forth to shoots. And if you're dropping stuff off at the post office or anything like that, all of those miles need to be tracked, but just tracking it isn't enough. You need to have documentation as to what it was for. So using an app like MileIQ or something similar is going to help you track that stuff, but you have to take the time by going in and making a note of what the trip was for. And it's just all, again, back to that thing you were talking about protecting yourself and making a potential audit super easy on yourself.
Totally. Even now, I'm like, as a business owner, I'm already nervous. I'm like, I need to go back and look through my MileIQ and make sure that I type out every situation. But it's, and we'll drop a link to MileIQ in the show notes too for people. Just if it's an app you've never heard of, we've talked about it before. Like, I love that app for tracking mileage. And that was one thing where sending my account my mileage for the year was very easy. And I was like, hey, here is everything. It's just like Tinder, but for miles, like swipe right if it's business. I love it. So one last thing, just because I know this is probably so boring for other people, but I love this. And if you want your business to be successful and healthy, like people like Amy they are almost like a personal trainer for the finances. Like they're going to know, one, how to make them better, what they're doing currently, and then what they can, they're going to help you predict the future, in theory, as long as things keep the same. But one last thing, and I know we touched on it, but just walk me through, because I think a lot of businesses don't even know the terminology. There's one last vocabulary thing that I think people should want to know is the profit and loss, if you will. So businesses will say, oh, he filed a loss this year. And oftentimes in our communities when we're starting out, it sounds like a good thing because we don't get taxed. But I know when I had to buy my house, I talked to a loan officer 2 years before, just because it's in my weird personality, just to be like, hey, here's what I'm thinking long term. What do I need to know as a freelancer? And he's like, you need to have 2 years of profit. And I was like, oh. And so instantly I was like, okay, I have different goals now. And that's going to change. And so we were able to buy our house, and, we had to pay a lot of taxes and whatever. But just walk me through the basics of like the loss versus profit for people that don't know about those things, and how they're essentially taxed differently on those two things.
Sure. So what a profit means is you have all of your sales, and those, that's if a client gives you $1,000 check towards their wedding, maybe that's a sale. But then you have all of your expenses that are going to be subtract from that total. So you have $1,000 wedding, but you have $50 in expenses related to it. So now you have a profit of $950. So the money that you received is greater than the total of your expenses. That's what a profit is. On the flip side, a loss would be if your expenses outweigh the money that you received from clients and customers. And the way those work with your taxes is with a profit, any other income that you have is going to be added to your business profit, and then you'll be taxed on that total. With a loss, let's say you have a day job and you have $1,000 loss generated by your business. That $1,000 loss will reduce your day job income that's going to be taxed. So it helps offset other income that you have, which sounds good, and it's not the worst thing in the world. But if you just worked your butt off for a year and made negative money, you essentially paid money to work your butt off, then it's not a great thing. And so you don't pay tax in that situation.
Right. Totally. That's why, that's essentially why we go back to that one part where the person's purchasing equipment at the end of the year. They're bringing that taxable income number down. Let's say that brought them into a loss. They're hoping that loss would make them less, taxable in that situation. Awesome. Oh my gosh. Let me see if there are any other quick questions I have, just because I've been peppering you. I'm sorry for this, but hopefully it's fine.
Yes.
I think I have two good questions for you that I think are still going to be helpful. One, we get this question all the time, and the problem with this particular question is there are financial reasons to choose between these options, but there's also legal reasons to choose between these options. And I think you already know which one I'm going to ask. Is walk me through if there are any tax benefits or advice for LLC, sole proprietorship, and S Corp, and kind of walk me through that, at least from your advice.
Yeah. So the sole proprietor versus a single owner LLC, there is going to be absolutely zero tax change. You're still going to file a Schedule C form. You're still going to pay the exact same taxes. From a legal perspective, you'll want to talk with a small business attorney, and they will tell you what types of legal protection an LLC would provide and how to protect that. Then essentially the next step up from an LLC is the S Corp. And with that, you would be filing a completely separate tax return for the business. And you also have to put yourself on payroll. And that doesn't mean just writing yourself out a check on a regular basis. That's literally like you're an employee of a company and you're getting a paycheck, you're having taxes withheld. And you also, because that's happening, you have to file payroll tax returns and deal with that. And so that's when a program like Gusto would come into play. But and Gusto is a payroll company that I love. So take a look at that if you're considering an S Corp. Look at the pricing for that, and talk with a CPA before you do that. I work with a lot of businesses who have jumped into that before they really knew what all was involved, and the payroll aspect of it, I feel like, is what really bogged them down and they hated. So do that before you jump into the S Corp. And the way that you get the tax savings from the S Corp, because that's what you're going to hear a lot is, jumped right to the S Corp. It's going to save you a ton of taxes. And it can for sure save you several $1,000s, but you need to be making enough money in your business for that profit or that tax savings to happen. And so I typically recommend, if it looks like your business is going to reach the $50,000 profit number for the year or higher, that's at least a starting point where you should reach out to your accountant and say, hey, here's where my business is at. Can we talk about what it would be like if I changed to an S Corp, and then go from there?
Right. Because there's so many things. You kind of alluded to gusto, but even just the time of doing payroll, even for yourself and for the business, to the additional expenses that your accountant's going to charge in theory to do the return on the business. Because like a lot of accountants kind of charge by like, how many forms do I have to submit to the IRS? Like they charge per 1099, they charge per different things. So, and then in addition, just the cost of the software, just the cost of, the extra bandwidth and all these things. And it's like that might add up to $3,000 to $5,000, and that might have been your tax savings. And so it's one of those things I see often. And yeah, I never heard a profit number, which is probably unwise, but I always heard like over 200K in revenue. They used a revenue number as the one of saying, hey, probably around that. But at the same time, if it's a lean business, then they're already hitting that number. But if they're not, then it's whatever. One last thing, hopefully last thing, unless you remind me of something else, is receipts. Everybody wants to know about receipts, and I'll say what I know, which is not very much, which is why I have a podcast where I interview experts like you. But like there are some states that no longer require you to have a receipt if you have the credit card transaction. And so a lot of business owners just are curious about what that looks like as far as receipts. And, it can be kind of tough for a lot of business owners to track all of that. And we feel like there's proof of it. Like I have the receipt in my email, and then I also have the transaction in my credit card. Like what, for our last question, Amy, tell me about the exciting world of receipts and why not? What are your best practices? What do you suggest for your clients?
Yeah. So just a little background on why you would even want to keep receipts from the IRS and state perspective. If let's say your meals and entertainment expense looked way too large, they might send you a letter. They might not audit your entire books, but they might send you a letter saying, please send us documentation of your 2017 meals and entertainment expenses. And so in that case, you would want to have something where you can provide documentation of who you were going out with and the amount, the location, to essentially back up that number. So that's where receipts come into play. They're going to be your backup for that information. It doesn't have to be a paper receipt. So like you said, a lot of our expenses are purchased online. We get a digital receipt. When that happens, I just archive it into a receipt folder in Gmail, and I'm done with it. My personal philosophy is I will deal, as long as I know where to find things, I will deal with that if it ever comes up, but I'm not going to spend a whole lot of time meticulously organizing all of my receipts by category right now. I don't need to spend the time on that. So as long as you are keeping digital or physical copies of receipts for, I would say 7 years. It sounds like a lot, but time flies. So hold on to things for 7 years, then you can toss them or shred them or delete them out of your inbox. And you'll just have that to refer back to. And then as far as the paper receipts go, some people might have other ways of doing this, but me personally, I just have little monthly envelopes in my office. And as soon as I get home from something, I make sure I get those receipts out of my purse so that they don't get ground up in the bottom and I don't know what they're for. And I just get them into the monthly envelope. And then, like I said, if the IRS or the state ever needs to see documentation, I can go back and grab them that way. But there are, like QuickBooks Self-Employed has an option. They have an app on their phone, or that you can have on your phone, where you take a picture of your receipt right then and there and link it to your expenses within QuickBooks. There's a bunch of different programs like that, or apps that you can get on your phone if you don't want to deal with trying to carry around the paper receipts and that sort of thing.
Totally. That was awesome. Thank you. And that's all of that is based too on like using some kind of debit or electronic payment, because in theory you also have the transaction to back that up as well. Like, but the receipt is the backup, but like if you're spending things on cash, then you definitely need to get a receipt, anyway.
I would avoid cash. I mean, I know some people can get themselves into trouble with credit cards and that sort of thing. So if you need to stick with a debit card, fine. But having at least that trail is just so helpful, especially when you're paying contractors and those sorts of people.
Awesome. Totally. Sweet. Well, man, that was like 3 adjectives in one. Amy, thank you so much for coming on and just letting us pick your brain. I'm sure we're going to get tons more questions, so we might have to have you back on someday. Where can people go to find you? What are some resources that you would send to people that they can find out more and maybe ask you questions or ask somebody like you questions?
Sure. So if you want to hang out with me on social media, I am updating Instagram often. So it's just at Amy Northard CPA .com, at Amy Northard CPA. And then my website, I have a blog that we update usually at least weekly with different topics. And that is just my website, amynorthardcpa.com/blog. And there's so much free information in there. And then if you want to work with me one-on-one, there's a contact button on there, but there's also a course that I created called Be Your Own CFO. And it's fairly short. You can access it for $30 a month. And it also works kind of like a retainer program for me. So you can ask questions as much as you want through the Facebook group that goes along with it.
Awesome. Thanks so much, Amy, for being on.
Thanks for having me.
Guys, I know that was really long and kind of a tough one to get through, not because of Amy, she's wonderful, but just because we're getting factual. You might have had to have your notebook out for that one. These are the things, guys. Like every episode is just about a certain topic that I've struggled with in business, something that I've been curious about, a question I've had, and I have a million questions. And so I know that you guys also have those questions. And this is one of those practical ones. It should be like episode 5, right after you do your pricing, talk to Amy or vice versa. But this is something that I think you should know, and you should really get a grip on just knowing those things out. One thing I ask all my mentees when they enter long-term mentorship is how much revenue did you make and what's your profit? And a lot of people don't know. They don't know how to calculate that. And that's something that's honestly, that's how you're going to measure success. You can't just say, hey, I was able to pay my bills and, I paid my taxes. Like, that's good, but we need to figure those out. Having a CPA or somebody like Amy can really help you, or even doing it yourself and just being really in touch with the numbers is going to help you as well. So thank you so much, guys. If you're interested in long-term mentorship, spots are officially open. You can go to the link in the show notes and apply for that, or shoot me an email at thebeardedtog@gmail.com. There's lots of ways to get a hold of me if you're interested, and I would love to get to know you a little bit more and help your business win over the next year. So thank you so much. Have a wonderful day, guys.